Well, hello. My name is Anton and I'm with Matt Marmotstein from our Lincoln office. And we're going to go through this week, this beginning of the week of 2023, and reviewing this weekly brief that we issued in written form titled New Start, New Year, New Start. And we're going to talk about that and add some other components to that brief as we went through it. And if you have any questions about this, feel free to give us a call. And we look forward to talking to you. So this is episode 44. And as I mentioned, it's a new year and a new start. And so one of the things that reminded me about the last 3 years, which have been historic, we've had the pandemic that was not isolated to a city or a region of the United States, but the whole world. And all the government agencies responded differently. And even China to this day is still dealing with zero tolerance and then releasing and reducing those zero tolerance. So there's a lot still going on. And what we're going to focus on is the impact on key asset categories, particularly the real estate and stock market. And then, of course, the mortgage and interest rate markets, who could not be paying attention to the Federal Reserve. And so, we'll focus on that. And then look at how that leads to maybe into 2023. So, Matt, it was quite a year last year.
It was
the stock market, and we're watching this all the time. Did 2020 and 2021 stock market, did that really surprise you? The way the market rallied and NASDAQ, or how were you thinking as it was going through that time?
Yeah, absolutely, it surprised me. When we were. As you remember, right around March 23rd, I think was one of the big days that we remember well. I was really concerned about what was going to happen. Worldwide shutdown, everything just being basically grinded to a halt.
Right.
Lenders getting scared, completely canceling on deals.
Right.
Yeah, it was actually a little terrifying at first. And we really, or at least I had never, experienced anything like this, a pandemic. You really didn't know which way it was going to turn.
Right.
I think luckily, our government kind of stepped in and maybe helped a little bit, maybe a little bit too much. We'll see how that plays out over the next couple of years. However, I was quite surprised at the acceleration of growth in both the stock market and the real estate market. Happy for it, very thankful.
Everybody,
all of us are. But I do understand, and of course we understand that that's not the norm, and it's probably time to get back to normal a little bit. And we were a little spoiled, and it's time to really get back to basics, get back to fundamentals. And really, expect a more normal growth, which is probably healthy.
So to unpack some of those things that you mentioned, from February 19th to March 23rd, 2000, the stock market dropped 35% in about 34 days. And it was the fastest drop, even faster than October 19th, 1987, when the market dropped 23% that day. This was 35%. And you had mentioned it was nice that it got back because we only had to wait 3 months to see our accounts back to where they were. So that was fantastic, but it's not the norm. And in fact, you and I were talking about the technology crash, 2000 to 2003. NASDAQ dropped 50% in that time period, and that was not a good time. That was a combination of technology companies going bankrupt. There was fraud that were issues that were coming out. Company stock options for employees went to zero. People lost their jobs. I happened to be living there, and traffic went from congestion to almost nothing. I mean, it was literally when I would get up and drive to downtown San Jose, there was nobody on the road. I mean, it was just an overnight, and the stock market dropped. And unlike this last period, there wasn't a slow recovery. It was 3 years, a grind all the way until March of 2003 that things actually started getting to better. But in this time period, after that 35% sell-off in 2020, the market took off. And in the 2 years of 2000 and 2001, the S&P went up 52% and NASDAQ went up 74%. I mean, not only did you not have to wait, it was a home run. And at the same time, because of the supply chain issues, not only did those stocks do well and NASDAQ did well, but Apple went up 141% as everybody was scrambling for computer equipment. So it was a very unique period of time. And then, of course, your brother works in the car industry. I mean, cars, campers, stereos. I mean, the lines out the door to buy TVs and all the home appliances. I mean, they went amazing. And a friend of mine bought a camper, brand new, $130,000 Mercedes camper, and was offered more when he came back from a 3-month trip and in 2020. So it was just unusual time period. But what we want to do is set up the framework of these last couple of years and then what happened last year. And is that a precursor to a sliding recession and continue poor performance in the stock market and real estate? So let's look at home prices to start with.
Sure.
You and I were talking about how home prices did so well these last couple of years. In 1950, the average median home was $7,354. So you could have afforded that, right? $7,354.
That's right.
But by 2020, the average house in the US was $336,900. So that's a decent growth, and that information is provided by World Population Review. But that's a 5.6% compounded annual return. So although it sounds like a lot, it's 5.6%. However, in 2000 and 2001, home prices ballooned to $428,000 for a 12.8% compounded return. That's more than double the historic average from the 1950 or 70-year average. Wow. So home prices really jumped way ahead of averages. And so it's only a matter of time, and home prices haven't really corrected at all, and certainly nothing like the stock market. The S&P down 19%. So that'll be interesting, Matt, to see if home prices correct in 2023, because we have not seen any reversion to the means of when you're ahead of an average, there's a time period you're below the average to be back to your average return. So we haven't really seen that. Now, stock prices we already talked about were phenomenal. As mentioned, the S&P up 52% in 2 years, or about 26% for those 2 years. So that's way above the 50-year average of 7.3%. And we had a correction, 20% on the S&P, 30% on the NASDAQ, but that doesn't necessarily bring it back to the average. So that there's still some premium pricing in there, but certainly some correction. And then home mortgages, of course, were unrealistic at 2% and 3%. Matt, I have a friend who told me he has a 1.9% fixed rate 30-year mortgage on his house. So wow, that's got to be do you have anybody that low?
Well, not that low, but I was personally able to refinance a lot of my rentals to 2.99. No,
Rentals.
Wow. Yeah, rentals 2.99. Yeah, 3 of them.
Because investment property is a higher rate than owner occupied.
Usually, yeah. So I was very happy with those rates. But again, not sure if it was sustainable.
Yeah. I joke with my wife that if we ever sell any of our houses, I'll ask if I can keep the mortgage.
Yeah, that's right. That's a good plan. Yeah.
So all of that corrected pretty strong. Home prices bounced up to almost 8%. Settled the year, the national average of the 30-year fixed mortgages is 6.88. The 40-year national average of mortgages is 6.33. So it has come not below the average, but certainly slightly above it. And that's good. It's been well below for a couple of years. Now it's above. And so that's kind of what you'd want to see. I would anticipate mortgage rates to settle even a little bit more, only because of demand and supply is still a factor, and affordability indexes are still high. So that'll come into play with house prices as well. So what is it? Let's pull this all together, Matt. What does it mean? So the first couple of years of 20 and 2021, especially in stocks, way ahead of the average. We saw a correction last year, and I would say that there's probably still some premium pricing in stocks, which means volatility and weakness may still continue for another quarter or two in 2023. But what it is doing is setting up what I believe will be a sustainable multi-year positive trend. And once that's established, I think another factor that's going to keep stocks are going to be the Federal Reserve, because investors are looking at how much more are the Feds going to tighten interest rates by raising them, and how much of a crunch will that put on companies, and how much will that put on individuals and households for their spending. So I think that's going to be a factor, Matt.
Yeah.
And then once we get through where investors are feeling more comfortable with the Feds and feeling more comfortable about pricing, that's when I think we'll start seeing it. Now, one point I wanted to mention is that assets of real estate and stocks do not correlate together. In fact, only twice have they gone down and correlated together on the downside since 1944. And in 2000 and 2003, during that tech bust, when stocks plummeted for 3 years, house prices actually went up. And last year, as an example, stocks went down, house prices went up. In fact, houses went up 5.6% last year. So it still was a year of growth. What's also interesting in the separation of value of stocks to profits is that while stocks prices were going down, and Tesla, as an example, shipped more cars in history, and the stock's down almost 70%, is that earnings grew last year on the S&P 500, average of 5.6%. S&P 500 companies, their net growth of earnings was 5.6%. Meanwhile, the stock market in the index went down 19%. So there is a value that's building between what the stocks are trading at and what the companies are actually intrinsic value and what they're worth. So that I think all of that's going to come together sometime this year.
Well, let me ask you a question then.
What's that?
So with corporate profits being up so high, and stocks being a little bit lower, is this an opportunity to buy? What's your thoughts on that?
So that's a great question. And with our portfolios, we're holding more cash in our portfolio since 2007, where we built up our cash quite a bit and held large cash allocations all through 2008. We're still hesitant to add more monies in the market. I think the Feds, which has been the story for 2022, is going to still be a factor with investors until there's a little more clarity what the Feds are going to do and how many more rate increases will there be. That's number one. Number two, I think there's still, as I mentioned earlier, a little bit of premium in stock prices. As earnings keep going up, that's just narrowing that, that gap. There's still, I think, going to be some hesitancy until there's a number of issues and clarity on them. Russia and Ukraine, will China go into Taiwan? Will supply chains be interrupted? So there's still, I think, enough out there to keep investors cautious. Okay. But I do think when the uptrend begins, it will be a sustainable uptrend. But answer to your question, I think we're probably a little bit early to begin adding some monies into the marketplace.
Got it.
Well, that was what we wanted to cover today, and to look at the last couple of years. It was terrific that we had big gains in 2000 and 2021, but most likely that was going to set up for some asset correction, which is what we've had, maybe a little bit more, but I think we're setting up and getting close to a point of where the next positive uptrend will begin in stocks. I think housing has a little more time to settle. What do you think about housing, Matt?
Well, there's a couple of things we have to consider about housing. One of those is I think a lot of people are kind of stuck right now. And I know I'm personally going through this, and a lot of my friends are, where you have assets like a house, and you have these 3% rate mortgages. And even if you wanted to sell that house, you might have a little bit cold feet because you almost feel like you may never get that again, at least not for a couple of years, the mortgage, that is. And so I think a lot of people may be hesitant to sell that asset because to get that kind of money at that kind of rate again might be very difficult. Also, I think because of rate increases, home builders are going to slow. So there's going to be less new homes coming to the market. And so you're going to have less inventory because of that. We still have an inventory issue in this country, and we still have people growing up and getting ready to buy their first house. So I don't think that's been solved yet. So I don't think houses will come down as much as people are predicting. because of those reasons.
Right. Yeah. Yeah. And as people are holding their homes, that slows down the movement of money and the transactions. And so then that reduces your supply and inventory. But at the same time, demand is also going down. So they haven't really come to a point where there's a growing demand and a shrinking inventory, and that's where prices go up. That's not quite there yet. So I would agree with all of that. And I think just like investors in the stock market are going to wait and see, I think people are also going to do the same thing with their home before and letting go of a 3, or in your case, 2.9 or 3% fixed rate, and knowing that the same price home was going to double your interest rate and have a significant change in increase of your payments, and most people don't buy the same kind of home, right? They want to buy a bigger home or a better home or a different location. So it's a double whammy in which your price purchase is up and your mortgage rate is up. So
exactly.
I would agree with that.
Yeah.
Well, that's today's episode. Thanks, Matt, for joining us. And we're going to continue having these conversations on the weekly briefs, as well as other topics we'll cover. Feel free to give us a call anytime. Send us an email. You can reach me at Anton at UpCapital MGMT, or Matt at UpCapital MGMT, and we'd love to talk to you. We'll talk to you soon. Bye.
Thanks, guys.